Welcome back. And just a quick reminder, we will have a replay of today's session today at 6 p.m. Eastern Time, which will include the curriculum as well as the question and answer session. Use the same login credentials as you have for each session. Each day, it's the same throughout. This section is starting on page right where we left off, 363 with Mark. This will go for about an hour, maybe just a little bit less than an hour. And then we'll have another break before we queue up the Q&A. We have a bunch of questions already. Same situation, try to organize them all in a single email. I'm getting multiple emails from people. That makes it very difficult, as well as be specific with the page number and any specific details you want to ask. General or hypothetical questions are really difficult for Mark to answer. And remember, we will have another question and answer session on the live trading day on Monday, November 21st. So that is something where you will have more opportunity and chances to ask questions that we don't get through to today. Also, just a reminder, we will get into risk management tomorrow. So there's some questions I saw on information or part of the curriculum we haven't even yet gone over. So do try to be patient, as you will learn more, including right now with selling and risk management tomorrow. So stand by for that, and let's get back to Mark and Mark, page 363.
Okay, welcome back. We're going to look at sell signals now, sell rules. And to do this, the first thing we want to discuss, and we want to go back to a satellite view even. We're going to go back to the stage analysis. And the first thing we want to identify is sort of where we are in the bigger time frame. Where are we within that stage 2, stage 3, stage 4 a maturation, part of the maturation cycle? And we're actually going to look at the PE ratio here as something that could help us identify if that move that has been made in the stock is getting long in the tooth, if you will. This is one of the few times that I do use the PE ratio where it becomes valuable. But even with this, it's only on certain instances where you even get this type of tip off. But the first thing that is very basic, and that I always do every time I look at a potential buy setup, these VCPs, of course, we're making sure it's in a stage 2 uptrend, but within that stage 2 uptrend, since the stage 2 uptrend started, I'd like to know what base we're at, how many VCPs set up. And the reason why is because we're trying to ascertain how obvious it is, and how, if it might be late in the cycle. So if we're on the 5th or 6th time that you've had a good sized base form, and the stock has made a really big move, and let's just say you've been in a bull market for a couple of years, that is what we would refer to as a late stage base. And we've got to be a bit more careful with that. That's not what I would call investment grade. That would be more of a trading opportunity, because the most of the juice is potentially out of the lemon, if you will. And it's no secret, once a stock has made a big move and there's been base after base after base, and all these breakouts have worked, it starts to get pretty obvious. And there's an indication there that's giving you an indication that you may be late in the maturation cycle. So that's first. We want to know where we are. And basically the rule of thumb is, when you're in the first, second, third base, those are more investment grade, if you will, where you can try to hold longer. And when you start getting a 4th, 5th stage basis, and certainly if you get 5th, 6th, you're getting to where you got to start moving to a more trading type style, and sort of take the money when you have it, and get the money, get out when the getting's good. This perfect example is 2021, where we got into a late stage environment. I was tweeting it all year long on how a percentage of stocks above the 200-day were diverging, and there was less and less participation, and we had already made a big move in the market. And so I switched over to just taking short-term profits, and it worked out quite well. And then sure enough, we went into a bear market shortly after, within the next 6 months to a year. So those are the signs. And they could also be when you get a lot of late stage. My good friend Stan Weinstein, who is the one of the very first people to ever write about this, him and Wyckoff with stage analysis. He keeps track of what percentage of stocks are in a stage 1, 2, 3, 4, similar to how I keep track of the percentage of stocks above the 200-day. Very similar analysis. But when there's a lot of stocks, he calls them the good guys. When the good guys are in control, the stage 2, that's where the market's healthy. When you get to stage 3 or the stage 4, stage 4 is usually indicative of or signs that you're in a bear market when there's a lot of stage 4 stocks. Right now, you don't. Go ahead.
Just to point out, Mark, I just wanted to point out, if you just look at the character of this example in Amgen, how when you're doing the base count, each base is getting wider as it's going up the mountain, to the slide. Where are we on the mountain? As you go up, each one is getting subsequently wider. And that's one of your main tip-offs to say, not only are you on base 5 here, this is the widest base since the beginning of the move. It's telling you the stock, everybody's in. To Mark's point before, when there's thousands of funds that own these names, that's thousands of potential sellers, to create the other side of the mountain, if you will. And that's precisely the cycle we're in right now with, say, the old FANG names. All the funds own them, and they're now net sellers.
Right. And when you take a look, a couple of things. One, when you take a look at the stages and you go back and you look at a stock that has gone through the 1, the 2, the 3, the 4, the 4 stages and that whole life cycle, you'll find that during that stage 2, you'll generally have, before you get a decent sized correction or a top that's a secular top, you'll have anywhere between 3, 4, 5, sometimes 6 bases. And then you'll get that volatility. And again, with this Amgen, this is an arithmetic chart. If we go over to taking a look at Yelp, this is a logarithmic chart. When you get into really big moves and you're looking at longer term timeframes, you want to use a log chart, because the log chart will then adjust things percentage wise. What's 10% down here will be adjusted, will be the same here, even though the price is a higher price, right? A $20 stock just has to move $2 for 10%. $100 stock has to move, obviously 10 points. So you can see, as Mark just said, look how wide this later stage base is. Just like we looked at, I think it was Decker's, exact same situation where you came out of this primary base. Here's your first base forming, second, third, and then that later stage base here, that fourth, is very wide. It comes off about 50%, and this is a faulty setup. This is a faulty VCP, and sure enough, it tries to break out, but then it fails. It rolls over, because that's the indication that the supply is now coming to market. See, there's a lot of volatility now, and
you see too, Mark. Yeah, see, Mark, at how the volume is really piling up in terms of this fourth stage base as well, which tells you there are definitely institutional sellers. And then as the name breaks again, you see more volume coming. This is just, this is precisely what we're seeing in some of these names. You and I were saying earlier in this year, people calling Netflix and Facebook and, oh, they're great buys, they're off 30, 40, 50%. And you and I are saying, no, this is horrible. Institutions are going to be selling these names. And sure enough, all of those late stage bases have cracked and made new lows.
Yeah, this is just showing the characteristics for stage 3, what to look for, because that's when you're in that stage 2, and you start getting into these later stage bases. Sometimes a stock will pop up, and it'll have this big VCP, and you'll get excited about it, but you got to put it into perspective and make sure that it's not this late stage base that's already been 6 bases and now it's got this big correction. The big correction, some people think like that's an opportunity. Wow, it had this big pullback, and they like it because it's down big. No, that's just the opposite. You want the stocks that are holding up the best, not the stocks that are performing the worst. Once they start getting real volatile, that's getting where a lot of supply is coming into the stock. Now, the PE ratio, and again, this doesn't always happen, but you can certainly take a look at it to get some additional confirmation if you're late stage or not. And when the PE, one of the things of looking at the PE is to look for PE expansion. And that's what we want. We actually want PE expansion, because when you have a stock that's moving up, if the earnings are coming out very strong, as we showed in valuation in the Apollo example, you went up 200%. And then a year or two later, after a 200% move, the PE was the same, because the earnings were moving just as fast as the stock price. The stock price was just adjusting for the earnings, and you were basically at the same valuation, even though the stock went up 200%. Well, when you get a stock that starts moving real strong and there's great earnings and there's some great story and the company's making a lot of money, what happens is that when it gets to the later stages, it starts to go faster than the earnings, and the PE starts to expand. And of course, you want that. You want a price that, takes off and goes up as fast as possible. But that's where you want to start considering selling, because now the price is getting ahead of the earnings. And when you start getting to where you move up a couple, 2-3 times where you've expanded, and now you're at 20 times. The PE was at 20 here when it first moving out of that. We're back to that Decker's example, as a matter of fact. You're coming out of first base. I was buying right here. Now you have second base, a third base, a fourth base. Now, when you come up here and you start coming out of that fourth base, you're now 2 times, instead of 20 times earnings, you're at 40 times. You've expanded. You've doubled the PE now. When you get to 2 or 3 times earnings and you're on late stage basis, you are absolutely late in the game, and that's where you really got to be careful not to, especially kind of cut your losses, and you don't want to be holding and buying these stocks when they turn down, as we saw in valuation. That's where all the problems happen, right? So again, take a look at Lumber Liquidators, another one we looked at before. When I'm buying it over here, right, this PE starts to expand. But when you go back and you take a look later on at that later stage base, this is where we showed the low volume out, high volume in example. This was that faulty base because it was late stage. You had the PE had gone, when you started the stage 2 uptrend, it went from 20 times earnings to 50. So now that means that the price is moving faster than the earnings. It's getting ahead of the earnings, and that means the price is going to come down at some point. And sometimes these really expand quite a bit. Like this is more than 3 times. This was Chipotle, where here's your first base, second, third, fourth. When you finally got to where it started forming this last base here, which did not hold, you were at 65 times earnings from 20 times. So this is just some big, broad perspective stuff where you're looking at the big picture. And this is also for longer term investors. If you're short-term trading, certainly all your trades are going to be trading opportunities, and maybe even these late stage bases you could trade, because you're going to have tighter stops. You're going to be trading at the strength, and this might not apply as much. But this was very simple analysis that I did with Home Depot back in the 90s, where the stock, a couple times I was in Home Depot coming off the 1990 bear market going to 91, and the PE had expanded dramatically, and I had sold it off of a late stage base, and then it went sideways for a number of years. It was 5 or 6 years, and then broke out there. The PE came back down, and then again, this big move, you see the PE expanded again, almost to right around the same level of up around 70, 75 times earnings. And then it topped right there. And these were both off of late stage bases. You had a base here, you had a base here, you had a base here. When you got to the 4th or 5th base and they had the PE expansion, that's where you're getting late in the game. Now, the other thing too is that when you get to that later stage, it doesn't mean, again, that you can't trade the stock. Later stage bases sometimes get what we call a climax or a blow off run in that late phase, where the stock gets really popular and just it has the biggest part of its move. This is the acceleration phase. The key is to identify whether you're early and it's a breakaway acceleration or it's an exhaustion. And again, when you count the bases, you take a look if there's been a lot of PE expansion, you've been up for a number of, maybe couple years in the stock, a bull market's been underway, and now you get that acceleration after a bunch of bases. That's where you're going to sell right into that. We're going to show you that in just a second, some of the sell signals. Now, these stocks can also reset, just like we saw the failure resets with the pivot failure and the base failure. Well, on even a larger scale, you can reset. But what happens generally when you have a stage 2 that exhausts itself and then finally